natural resources. And actually we've gotten into some royalty investments as well. But it really comes down to that risk-return initiative and focus. And we go through that on an annual basis. Probably the next step for us, I mean, we've done everything through fund to funds. We've moved from fund to funds in other areas to direct investing.
A little bit of what Kevin was saying, it kind of helped us in some of the problems we had. But in reality, I am going to echo exactly what Kevin said. The wrong way to approach a foundation would be to view us as a bag of money, as opposed to an organization that has a mission that it's trying to accomplish, and it has some problems, like any organization, in accomplishing that. And so you should approach us with a way to help us get our mission done, our overall mission done.
Great. Let's open it up to the audience. We are happy to take questions. Sure, thank you.
It seems to be that both of you have been saying that you invest through fund of funds and through other managers. So why would an entrepreneur spend all the time and effort approaching a foundation directly when the bulk of the foundation's money is going to be managed by outside managers like fund of funds? Is that a productive use of time for an entrepreneur when you're setting up companies? You're 24/7. They're the easiest sources of capital. And you have foundations who are putting, like you just put the percentages up, like 80-90% of the money is managed by, fund of funds and other asset managers. So it's such a small pool of capital and such a long shot. I found it personally, I'm from Connecticut, but I do all my startups in Palo Alto. I raise money on the tennis court. The game of tennis in the morning, I leave and I have an investor ready to write a check. Going through this route seems extremely cumbersome. Very, very long shots. Is there a better approach?
I think you're talking about different types of money, first of all. Because, yes, I think approaching an individual or a family office is going to be very different than approaching a socially driven private foundation or an endowment. Yeah, I have some additional hoops to jump through. I mean, there's governance structure. I can't tell you I'm going to go back to my office and write a check. It's got to go through our vetting process. I'm going to want to go visit you. And plus, at this point, as I mentioned, we have not made direct investments. That really is our next, to me, that makes sense. In our evolution, what would come next? And with that comes co-investment, in which case I would be talking to you. But are we there? Is the University of Connecticut Foundation there yet? Not yet. But there are many institutions who are. The Yales, definitely are there.
Yeah.
So.
Stanford University has a very active program. So it's likely to direct money into startups, share companies. I think we need something like that in Connecticut. Connecticut's clearly looking to create jobs and innovation. And I think UConn should be a leader in that endeavor.
I agree, and that's one of the major focuses of our new president. So Susan Herbst has said on a number of occasions and actually created an Office of Economic Development that did not exist before. And so the opportunities I mentioned as far as how to tap into the university, now it's more operational. So it's not how can I get you some capital. It's more how can I give you facilities, laboratories, research, labor that will help you with get your operations off the ground. So that's where the university is focused right now. And then Mark Van Allen and others, if you do tap into the university and something becomes a university-aligned company, then that's something that he'd be able to then take a look at.
I think just looking at the big picture of that, it's much easier to raise money for investors, but you still have to match up what you're trying to do as a business with the type of investor you're trying to bring on board. And to be honest with you, in life sciences, which has been a bumpy road for financing and very dependent on venture capital, we were very concerned a few years ago about money that was available among our syndicate partners and slowness of getting deals done with pharma and whatnot. And so we started bringing in a lot of non-dilutive capital through grants and whatnot from private foundations that matched up with our mission or the federal government. So we at Canaan actually raised about $1 billion of combination of DOD and other non-dilutive capital. Actually, one of my companies, the Gates Foundation, made its first private investment in a technology that matched up very well with their mission around creating new vaccines. And it took a while. It went through all the same sorts of hoops that we're discussing here that Lynne mentioned. It wasn't easy for them, but we felt it was a great asset to have as bringing resources and not just the money, but the resources and the people around it, which has been fascinating to watch. So you have to really match it up, and it fits better life sciences probably. I mean, Facebook isn't exactly fitting the mission of somebody's endowment. Other questions? Liddy?
I have a question. I often hear people talk about investing through funds of funds, and I understand that from a resource allocation point of view, it's probably more efficient at some level. But I also hear concern about the double promote, the sort of double fees that happen on that. And just would like to hear your take on that. Is that really an impediment to your moving in that direction, or not?
I don't know if you have anything to say about that.
Not really. That's not my area of expertise, and so as far as the fees and all, so I'm sorry I couldn't answer your question.
Essentially, the way we view it is we're paying for a consultant. So that's what the role of the fund-to-funds manager is. They are an active, outsourced consulting service who's putting together a portfolio for us. And so that's why you're paying the additional promote. If that's not why you're paying the additional promote, why would you do it? For exactly that reason. If you have the resources to go out and identify direct fund investments or direct investments, co-investing opportunities, and you have the resources available to you, then the fee structure doesn't make sense for you to go that route. Unless you can't get access to something, or there's some kind of, you want something really geographically specific and you can't send people there. But otherwise, you're right on point. The only reason to do that is if you don't have the resources and you were essentially outsourcing a consulting relationship.
Other questions? Well, if not, I'm going to hand it over to Liddy, who's going to give a little farewell.
Thank you, Steve, and thanks to our panelists. That was really terrific, and just having access to you here, we think of you as really representing your entire industries, and so I think it's quite relevant to all of us to understand how difficult, I hate to say this, it is to raise venture capital funds today, and also certainly any entrepreneurs know how difficult it is to raise funds directly. But what we have to understand is that we don't have to think strictly in the paradigm of going out and raising the kind of fund that Steve raises. He's a top-notch investor with terrific returns. Many of us don't have that kind of track record, and so we have to think about working directly with you, looking at your mandates and your objectives and trying to